Welcome back to the deep dive, and a very special welcome to you, the learner. We are so thrilled you're joining us today.
Yeah, really glad to have you here.
So think back to the July 4th holiday weekend earlier this month. Millions of cars, bumper to bumper, just totally gridlocking the highways because, well, the physical roads literally could not handle the sheer volume of vehicles trying to occupy the same space.
Right, a total standstill.
Exactly. And today, July 29, 2026, we are seeing that exact same massive, sprawling traffic jam, but it is happening to the world's AI infrastructure.
The digital highways are just completely jammed, and the underlying systems are really starting to buckle under the weight.
Yeah, and so the mission of today's deep dive is to take this massive stack of recent tech reports, financial filings, industry data, and really just sift through the noise to extract the bigger picture of where artificial intelligence actually stands right now. So, okay, let's unpack this. Where are we?
Well, if we look at the through line connecting all these reports, it's basically this. We are witnessing the unstoppable force of massive AI demand just slanting headfirst into the immovable objects of physical infrastructure, geopolitics, and, societal norms.
Right.
The theoretical, limitless phase of AI, that's over. The industry has officially hit the physical wall.
Let's start with that collision, actually. The unstoppable force meeting the server rack. Because the adoption metrics hitting the wires this week are, they're almost hard to process. ChatGPT is currently approaching 1 billion weekly active users based on some internal data that just leaked.
Yeah, and that weekly milestone is highly revealing. It actually arrives about 7 months behind OpenAI's original internal projections.
Oh, really? 7 months late?
Yeah, they hit a pretty noticeable growth slump last fall when there was all that significant public backlash over GPT-5. But the underlying demand just proved too strong to suppress for long.
And the broader monthly numbers completely confirm that. Back in June, ChatGPT crossed 1 billion monthly active users. That officially makes it the fastest consumer app in human history to hit that mark.
Right, totally blowing past the growth curves of TikTok, Instagram, Google Maps, all of them.
Yeah, but here is the friction. The physical toll this scale is taking on the systems running these models is becoming impossible to ignore. On the exact same day we got the news about ChatGPT's billion-user march, Anthropic's Claude went down worldwide.
Literally the same day. Starting at 7:49 p.m. UTC, users globally were hit with 529 overloaded errors.
Wow.
And, this wasn't just a glitch on the Claude.ai web interface.
Yeah.
The failure cascaded across all their API-connected tools, just knocking out third-party apps relying on their models. And this is Claude's fourth significant disruption in July alone.
Fourth in 1 month.
Exactly. It perfectly illustrates a widening fracture in the AI ecosystem. The model layer companies like Anthropic or OpenAI building the actual AI brains, they are struggling under immense compute loads just to stay online. But if you look the hyperscaler layer, the companies that own the actual physical cloud servers, they are operating in a totally different reality.
Oh, the hyperscalers are printing money. Microsoft just reported their Q4 fiscal year 2026 numbers, and I want to make sure we get this right because the scale is massive.
Well, the scale is basically defining the global economy right now. Microsoft reported Q4 revenue of $90 billion.
$90 billion.
Yeah, which is an 18% jump year over year. But the standout metric is Azure, their cloud computing platform. Azure grew 43% and topped $100 billion in full-year revenue for the very first time.
That is wild.
Right. They also reported earnings per share of $4.74. And crucially, CEO Satya Nadella noted that Microsoft 365 Copilot has actually surpassed 30 million paid seats.
30 million paid seats. That is the concrete monetization signal investors have been just desperate to see, right? Proving people will actually pay monthly subscriptions for this.
It absolutely is. And furthermore, Microsoft's quarter included a $3.2 billion gain from their investment in Anthropic.
Wait, really?
Yeah. The irony there is stark. The company owning the infrastructure reaps a multi-billion-dollar financial gain from the exact same AI lab that is struggling to keep its servers from overloading.
Wow, that really shows you who holds the real leverage.
Exactly. But, to understand why the servers are overloading, we have to look at the capital expenditures, the CapEx.
Yeah, and here's where it gets really interesting. Because the spending required to keep this going is almost unfathomable. Between Amazon and Microsoft, they are projected to spend a combined $400 billion on AI infrastructure just in 2026.
Just this year.
Right. And Microsoft just guided their fiscal year 2027 capex at $255 to $260 billion. That is a 35% jump over their already record-breaking 2026 spend.
They are betting everything on the thesis that the demand will outpace the cost. Microsoft expects Azure to grow 45% in Q1 of 2027. And on the Amazon side, AWS is sitting on a $364 billion remaining performance obligation backlog.
Okay, hold on. Before we throw around more billions, what exactly does a remaining performance obligation backlog mean in this context? For the learner, let's break that down.
Sure. Think of it as contractually guaranteed future revenue. It means AWS has customers who have already signed binding agreements to buy $364 billion worth of cloud computing power in the future.
Okay, got it.
So for the financial bulls, that backlog acts as a massive shock absorber. It allows Amazon to justify spending hundreds of billions on physical data centers today because they have the signed contracts proving the demand is already locked in for tomorrow.
I look at these numbers, and to me, it feels like the transcontinental railroad boom, right? These tech giants are laying thousands of miles of incredibly expensive track, hoping the economic boom of the trains will eventually pay off the debt of the steel.
That's a great way to look at it.
But laying that track is risky. I mean, Alphabet's stock recently dropped 7%, specifically because investors got anxious over their massive capex spending, dragging down free cash flow. So are investors really going to tolerate this level of infrastructure spending indefinitely?
Well, Microsoft's CFO, Amy Hood, had to explicitly address that anxiety on their earnings call. She confirmed they expect to remain cash flow positive through this entire build-out.
Right.
But investor tolerance is entirely tethered to demand staying aligned with the spend. The moment that RPO backlog shrinks, or the moment those 30 million Copilot seats stop renewing, the financial floor falls out.
Exactly. And all that $400 billion infrastructure spending isn't just numbers on a spreadsheet. Every dollar translates into physical material. Real-world silicon chips, server racks, copper wiring.
Yes, the physical hardware.
And that physical reality drags AI directly out of Silicon Valley and into the messy world of global geopolitics and manufacturing.
Absolutely. And if we connect this to the bigger picture, you can see this physical friction playing out in markets right now. The Philadelphia Semiconductor Index just posted its fourth straight loss, which is the longest losing streak of the year.
Wow.
Yeah, and it dragged the NASDAQ 100 dangerously close to correction territory.
Wait, but if there's $400 billion being aggressively spent on AI infrastructure, why are the companies making the chips taking a beating?
It's two intersecting pressures. First, the CapEx debt fears we just discussed, investors worrying the tech giants might tap the brakes on buying chips. And second, and honestly more structurally, reports emerged of a major DUV lithography breakthrough in China.
Deep ultraviolet lithography. That's the technology used to actually print the microscopic circuits onto the silicon.
Right, yes, exactly. Think of DUV lithography as a highly complex printing press for semiconductors. For a long time, Western and allied companies held a near monopoly on the most advanced versions of these presses.
Right, which was a huge advantage.
Huge. That monopoly created a massive financial moat for U.S. and European chip stocks. So a credible breakthrough in China means that moat is eroding, altering the global balance of who can physically manufacture AI. And that brings us to the physical robotics arms race exploding alongside the silicon race.
Oh man, the physical arms race is escalating fast. I mean, the FCC just issued new rules banning the import of foreign humanoid robots, quadruped robots, the robot dogs, and connected power inverters.
Right. And looking at the regulatory filing impartially, the FCC cited supply chain vulnerabilities and severe cybersecurity risks to critical infrastructure as the justification for the import block.
Gotcha.
This effectively targets China, which currently controls roughly 85% of the global humanoid robot market. So naturally, China's embassy strongly condemned the move, viewing it as an anti-competitive threat to their companies.
And this ban adds a very sharp new flashpoint to U.S.-China tech tensions, especially with the planned September summit between Xi Jinping and President Trump just weeks away. The digital trade war is now a physical robotic trade war.
It really is, and the Chinese domestic market is accelerating regardless of the U.S. ban.
Yeah.
I mean, Chinese automaker BYD is unveiling its first humanoid robot in early August at its Zhengzhou D Space Center.
Really? BYD, the car company.
Yeah, and BYD's leadership has floated a target of deploying 2 to 3 robots per dealership within the next 1 to 2 years.
Okay, I have to push back on this hype for a second.
Well,
Am I really going to walk into a car dealership in 24 months and negotiate my lease with a humanoid robot? Because BYD executives are claiming that manufacturing capability, not the AI model specs, is the decisive competitive edge in robotics. How does that logic actually hold up?
it is actually a very sound mechanical engineering argument, believe it or not.
Hmm.
Building a highly intelligent AI model is a math and compute problem, right? That software can be infinitely copied and updated over the cloud in seconds.
Sure.
But building 10,000 robotic titanium joints, actuators, and power arrays at scale affordably without them breaking after 1,000 movements, that is a metallurgical and industrial scaling problem. The software is the brain. But BYD is betting that the company that can mass produce the physical skeleton fastest will actually own the market.
Huh. Okay, that makes sense. And the US players are racing to scale up those skeletons too. Agility Robotics just announced a definitive business combination with Churchill Capital Core FEI to go public via a SPAC.
Right.
That values Agility at $2.5 billion. And they disclosed over $300 million in multi-year orders for their Digit V5 robot, backed by 65,000 operating hours across 9 customer sites.
Which really proves the enterprise demand for physical automation is no longer theoretical. But, while governments focus heavily on who gets to build the physical robots and chips, corporations are quietly fighting a much more lucrative war over the software stacks that actually make this technology usable in an office.
Yes. The shiny object phase of AI, where we were all just amazed a chatbot could write a decent poem, that is completely over. Now it is entirely about making it work securely at your office desk, integrated right into your daily workflow.
And what's fascinating here is how the definition of the best AI model has fundamentally shifted. A highly respected enterprise guide, the Gemini versus Copilot 2026 comparison, just concluded its latest evaluation, and the verdict: there is no clear raw winner anymore.
Wait, it's a dead heat.
Essentially, yes. The guide concluded that Google's Gemini leads for organizations heavily built on Google Workspace, while Microsoft's Copilot holds the distinct advantage for environments running Microsoft 365.
Ah.
For mixed-stack companies, there is no decisive advantage at all. We have reached a maturity plateau where integration depth and workflow distribution matter far more than just having the smartest raw neural network.
So what does this all mean? To me, it means choosing an AI for your company is like the old Mac versus PC debate from the 90s. It isn't about the hardware specs anymore. It is entirely about what ecosystem your office already lives in.
Exactly.
If your company runs on Word and Excel, you are getting Copilot. If you run on Docs and Sheets, you are getting Gemini. The ecosystem dictates the AI.
And the major platforms are acutely aware of this ecosystem lock-in, and they are aggressively forcing developers to commit. GitHub is a prime example this week.
Oh, yeah.
They are forcing developers' hands by retiring Gemini 2.5 Pro and Gemini 3 Flash from all Copilot experiences, chat, inline edits, agent modes by July 31. They are also fully shutting down their experimental GitHub Models inference platform on July 30. They're just funneling everyone toward their preferred production-ready providers.
And GitHub is also rolling out expanded usage metrics. Copilot app activity is now being tracked per individual user. Admins can see exactly who is using what feature, which model, and what coding language every single day.
Which is huge because that telemetry is absolutely essential for the corporate CFOs we mentioned earlier.
Yeah.
When a company is spending millions on an AI site license, they can no longer just buy it and hope employees figure it out.
Right, they need proof.
Exactly. They need hard per-user data to justify the massive software spend against actual productivity gains.
And OpenAI is pushing hard to expand its footprint in this knowledge workspace, too. They just launched ChatGPT for academic researchers, pushing their tools much deeper into scientific discovery.
Yep.
And this follows their July 10 launch of GPT 5.6 and the unified ChatGPT workspace. But more importantly, they expanded ChatGPT Voice into the Work and Codex desktop apps. Users can now coordinate multi-step agentic tasks entirely by speaking to their computer.
That word agentic is critical. We are moving from AI as a conversational chatbot to AI as an autonomous agent. You aren't just asking it for a recipe anymore. You're verbally authorizing a digital worker to go into your files, extract data, format a report, and email it.
It's incredible.
It is. But this raises an important question about the threat landscape, which brings us to the massive security vulnerability these agents create.
Oh, the security alarms are definitely ringing. Crunch-based data shows AI security startups have raised an all-time record $855 million across more than 150 seed rounds so far in 2026.
That is a staggering amount of seed money.
It really is. Oak raised $60 million, Lake took in $45 million, Jetstream's security raised $34 million.
And investors are pouring almost $1 billion into these seed rounds as a direct response to recent high-profile incidents, specifically the OpenAI agent breach of Hugging Face.
Right.
When an AI was just a chatbot, the worst security threat was it generating bad text. But when an AI is an agent with permission to execute tasks inside a corporate database, a hijacked agent becomes a catastrophic entry point for malicious hackers.
And once you deeply embed these autonomous tools into the daily grind of millions of office workers, scientific researchers, and software engineers, you inevitably trigger a human reaction. The technology is colliding head-on with human culture, creator rights, and the legal system.
The cultural fault lines are cracking wide open, starting from inside the industry itself. Anthropic is currently facing a massive Silicon Valley backlash over an OpenAI safety letter that was signed by over 1,100 AI workers.
Yeah, these workers are calling for a pacing of development, prioritizing safety checks over raw speed. But I have to ask, how does that demand for pacing reconcile with the venture-backed reality we just discussed?
It doesn't. That is the fundamental contradiction tearing at the industry right now. Critics point out that calling for thoughtful academic pacing directly contradicts the commercial urgency of the market.
Right.
You cannot easily tell a hyperscaler to slow down when they have committed $400 billion in CapEx that requires immediate hypergrowth returns to avoid financial collapse.
And we see a similar tension in the creative communities. I mean, the tools are getting undeniably better. Midjourney just launched V8.2, featuring bolder aesthetics, far better personalization based on your rating history, and a massive reduction in low-quality outputs.
The sheer quality of the generation is just soaring.
It really is. But the human creators are pushing back against the entire ecosystem. Substack writers are aggressively organizing against a proposed AI content detection feature on the platform.
Yeah, that's a big controversy.
They are warning that these AI detectors are notoriously inaccurate and that a false positive could permanently ruin a human creator's reputation.
And they have a point. AI text detectors rely on pattern matching and predictability scores. Human writing, especially good human writing, is often idiosyncratic, which can trigger false positives.
Right.
The platforms want to police AI-generated spam to maintain quality, but the current detection technology simply isn't reliable enough to deploy without causing immense collateral damage to genuine writers.
Exactly. And when culture clashes with technology and neither side yields, it ends up in the courtroom. We are seeing major legal battles unfold this week as the legal system scrambles to establish guardrails.
Definitely.
And again, just looking at the facts of these cases neutrally here for you, the learner. XAI is suing the state of Minnesota to block a first-in-the-nation AI notification ban that is set to take effect on August 1st.
Yeah, the Minnesota law passed with overwhelming bipartisan support. The vote was 132-1 in the House and 65-0 in the Senate.
Ah, that's near unanimous.
It is, and it carries severe penalties of up to $500,000 in fines.
But XAI has filed a federal lawsuit arguing that the law is an unconstitutional content-based restriction on free speech. They argue it would force their Grok Imagine tool to overly restrict legitimate image editing features for users statewide.
And that is just one front in the legal war. In a separate federal case, on July 15th, the New York Times sought sanctions against OpenAI in their ongoing copyright dispute, alleging that OpenAI withheld crucial evidence regarding their training data.
Right.
These lawsuits really represent the messy reality of applying slow-moving traditional legal frameworks to a technology that outpaced them years ago.
It really feels like the digital world is crashing into the physical world from every possible angle. So to synthesize all of this for you, the learner. July 2026 represents the exact moment artificial intelligence officially entered its growing pains era.
That's a great way to frame it.
The days of solely debating the theoretical capabilities of an AI model are over. Today, those theoretical concerns have been entirely replaced by the very real, very physical limits of overloaded server capacity, international trade law, enterprise ecosystem lock-in, and fierce cultural and legal backlash.
The digital has become stubbornly physical. And that leaves us with a final, perhaps vital thought to consider.
Okay, let's hear it.
We've discussed how surging AI demand is already causing global server outages and how it is forcing unprecedented record-breaking corporate spending just to build enough data centers to keep the lights on. But what happens when our digital ambitions finally outpace the physical limits of our power grids?
Ah, the ultimate bottleneck.
Exactly. Will the AI revolution ultimately be capped not by a lack of human innovation or lack of venture capital, but by a simple, unavoidable lack of electricity.
That is a staggering thought to leave on. A multi-trillion-dollar industry just stopped by a blown fuse. Well, we're going to leave you to mull that one over. It has been an absolute pleasure having you with us as we untangled this massive AI traffic jam. Thank you so much for joining us on this deep dive learner. Keep questioning, keep exploring, and we will see you next time.